Silver is still falling, but the biggest move is yet to come. Silver just dropped again, and right now, millions of investors are doing exactly the same thing, staring at that red number on their screen, feeling that familiar knot in their stomach, and asking themselves, did I make a mistake? But here's what they're not asking. What if this drop, this exact moment of maximum fear and uncertainty, is the last chance you get before silver makes the biggest move of this decade? Stay with me, because what I'm about to show you is not what the mainstream financial media is telling you. And by the time this video ends, you will understand this market in a way that very few retail investors ever do. Here's the truth about silver that most people completely miss. Silver is not just a precious metal. It is not just jewelry or coins or something your grandfather buried in the backyard. Silver sits at the exact intersection of two of the most powerful forces operating in the global economy right now: a monetary crisis that is quietly accelerating, and an industrial revolution that is devouring physical supply at a pace the world has never seen before. And yet, right now, silver is falling. How is that possible? That is exactly the question we are going to answer today. And when you understand the answer, the price action you are watching right now will stop looking like a disaster and start looking like a setup. In this video, we are going to cover three things. First, why silver is falling and why the reason might surprise you. Second, what the smart money is doing right now while retail investors panic sell. And third, where the real opportunity is hiding and how to think about what comes next. Let's begin. Section 1. Why silver is falling. To understand why silver is falling, you need to understand something fundamental about how modern financial markets actually work. Most people think the silver price is determined by supply and demand, by mining output, by industrial consumption, by how much physical silver is being bought and sold around the world. And in a fair, transparent, fully functioning market, that would be correct. But that is not the market we live in. The price of silver is primarily set in a paper market, the COMEX, the Chicago Mercantile Exchange, a system of futures contracts, legal promises to deliver silver at a future date, that trade at volumes that dwarf the actual physical metal that exists in the world. Think about that for a moment. More silver is traded on paper every single day than is mined globally in an entire year. The paper market is not a reflection of physical reality. It is a completely separate financial construct, and it is this construct that is currently driving the price down. Here's how it works in practice. When large institutional traders, hedge funds, banks, algorithmic systems want to push silver lower, they sell futures contracts. Massive quantities of paper silver, flooding the market in minutes or even seconds. The price falls. Retail investors see the red candles and panic. Stop losses get triggered. More selling follows. The drop accelerates. None of this requires a single ounce of physical silver to change hands. This is not a conspiracy theory. This is the documented, openly operating mechanism of the modern commodities market, and it has been happening to silver for decades. But here is where it gets interesting. This paper manipulation can only work for so long, because physical silver is not paper. It is a real, finite, exhaustible resource. And right now, the physical market is telling a completely different story than the paper price. Section 2. The physical reality. Let me give you some numbers that should make you stop and think. The Silver Institute, which tracks global silver supply and demand with institutional precision, has reported a structural supply deficit in the silver market that has now persisted for several consecutive years. That means the world is consuming more silver than it is producing every year, and that gap is widening. Why? Because the industrial demand for silver has changed permanently. Solar panels. Each gigawatt of solar capacity requires millions of ounces of silver, and the global solar build-out is not slowing down, it is accelerating. Every government in the world, from Washington to Beijing to Brussels, has committed to renewable energy targets that require silver at a scale the mining industry simply cannot keep pace with. Electric vehicles. Silver is a critical component in EV battery management systems, charging infrastructure, and onboard electronics. Every EV that rolls off a production line contains silver, and the transition to electric mobility is now a structural, irreversible trend. Artificial intelligence infrastructure. The data centers being built to power the AI revolution consume enormous quantities of silver in their electrical systems and cooling technology. The world is physically consuming silver faster than it can mine it. So explain to me, how is the price falling? The answer goes back to the paper market, and it reveals something critically important. When there is a disconnect between the paper price and the physical reality, when the market is telling you that silver is cheap at precisely the moment that silver is becoming structurally scarce, that is historically one of the most powerful setups in commodity investing. It does not happen often, but when it does, the eventual correction is violent. Section 3. The Shanghai Divergence. Here is something that almost nobody in the Western financial media is talking about. While COMEX silver is falling, a completely different dynamic has been developing on the Shanghai Futures Exchange, China's domestic silver market. Over the past several months, silver prices on the Shanghai Exchange have periodically traded at a significant premium to COMEX prices. That means physical silver in China is worth more than the paper price in New York is suggesting. Why does this matter? Because China is not just a consumer of silver. China is the world's largest manufacturer of solar panels, EVs, and electronics. China is buying physical silver at whatever price it needs to pay because it needs the physical metal to keep its industrial machine running. And when the world's largest industrial consumer of a commodity is willing to pay more than the market price, that is a signal, a deep structural signal about where the true clearing price of silver should be. This divergence between East and West, between paper price and physical price, between what the futures market is saying and what industrial consumers are actually paying, this is the hidden tension building beneath the surface of the silver market right now. And here is the uncomfortable truth. These divergences do not last forever. Something has to give. Either the physical market corrects toward the paper price, which would mean a dramatic slowdown in industrial demand that nothing in the data currently supports, or the paper price corrects toward the physical market. History suggests it is always the second outcome. Section 4. The Federal Reserve Dimension. Now, let's add another layer, because silver does not move in isolation. It moves in relationship to monetary policy, interest rates, and the value of the US dollar. And right now, the Federal Reserve is walking an extraordinarily narrow path. On one side, inflation. The structural forces driving price increases are not fully resolved. Energy transition costs are inflationary. Deglobalization is inflationary. Fiscal deficits at the scale we are currently running are inflationary. The Fed knows this. On the other side, the economy. Elevated interest rates are putting pressure on commercial real estate, on regional banks, on corporate debt refinancing, on the housing market. The Fed knows this too. If the Fed cuts rates aggressively, which the bond market has been pricing in, the dollar weakens, real yields fall, and monetary metals like silver historically move sharply higher in that environment. If the Fed keeps rates elevated, or if a credibility crisis emerges around fiscal sustainability, gold and silver often move higher as alternative stores of value, as the market loses faith in paper currency. In other words, in the current macro environment, the directional case for silver is constructive from multiple different angles simultaneously. That almost never happens. Now add one more dimension. The global de-dollarization trend. BRICS nations, Brazil, Russia, India, China, South Africa, and now a growing list of additional members, have been systematically reducing their dependence on the US dollar for trade and reserves. As this process continues, the demand for alternative monetary assets, gold and silver, increases at the sovereign level. This is not a retail investor trend. This is central banks and sovereign wealth funds quietly repositioning at a scale that does not move in a straight line, but moves nonetheless. Section 5. The gold-silver ratio. Let's talk about one of the most powerful timing indicators in the precious metals market, the gold-silver ratio. Right now, the gold-silver ratio is historically elevated. That means you need significantly more ounces of silver to buy 1 ounce of gold than the long-run historical average would suggest. Historically, when this ratio reaches extremes, when silver is deeply undervalued relative to gold, it tends to mean revert. And when it does, silver does not just catch up to gold, silver typically outperforms gold dramatically on the way back. This has happened in 1980, it happened in 2011, it happened in the period following 2020. Each time the ratio compressed from extreme levels, silver posted percentage gains that significantly exceeded gold. The ratio right now is telling you the same thing the supply deficit is telling you. The same thing the Shanghai premium is telling you. The same thing the macro environment is telling you. Silver is cheap relative to almost every historical benchmark that matters, but cheap can get cheaper. That is the uncomfortable reality that every honest analyst has to acknowledge. The setup is clear. The timing is always the hard part. And this is exactly where the mental discipline that separates sophisticated investors from everyone else becomes critical. Section 6. What smart money is actually doing. While the mainstream narrative is focused on the falling price, while social media is filled with bearish takes, with people declaring silver is dead, with analysts pointing to technical breakdowns and predicting further declines, something else is happening beneath the surface. Physical silver premiums at dealers remain elevated. That means the people who want to take actual delivery of actual silver are still paying prices meaningfully above the COMEX paper price. That spread between paper and physical tells you that real demand is not collapsing, even as the futures price drops. COT data, the Commitment of Traders Report, which tracks positioning of large commercial traders and speculators in the futures market, has historically shown that extreme speculative short positioning in silver often precedes sharp reversals. When the short side becomes too crowded, any catalyst, a dollar weakening, a surprise Fed pivot, a supply disruption, can trigger a violent short covering rally. The largest, most sophisticated players in this market do not telegraph their moves. They accumulate quietly during periods of maximum pessimism when retail investors are selling. They position themselves before the move, not during it, and certainly not after it. This is not a new phenomenon. It is the oldest pattern in market history, and right now, by multiple measures, we are in a period that has historically been associated with institutional accumulation in the silver market. That does not make the pain of watching prices fall any less real. But it does reframe what that falling price actually means. Section 7. The Risk Framework. Now, and this is important, let me be direct about something. Nothing in this video is a guarantee. No one can tell you with certainty when silver will reverse, how high it will go, or whether the timeline will be weeks, months, or longer. Anyone who tells you otherwise is not giving you analysis. They are selling you something. What I can tell you is this. If the structural supply deficit continues to widen and current industrial demand trajectories suggest it will, the physical market will eventually overwhelm the paper price. The math of scarcity is relentless. If the Federal Reserve pivots toward monetary easing, which the trajectory of the credit cycle historically demands, real yields will fall and monetary metals will benefit. If de-dollarization continues at the sovereign level, and there is no evidence it is reversing, alternative monetary assets will see sustained demand from the largest holders of capital on Earth. If the gold-silver ratio continues to sit at historically extreme levels and mean reversion remains a persistent feature of financial markets, the probability of silver outperforming gold over the medium term remains structurally high. None of these are guarantees. All of them are conditions. And right now, an unusual number of these conditions are in place simultaneously. That is the honest assessment. So here is where we are. Silver is falling. The paper market is doing what the paper market does, creating fear, shaking out the weak hands, testing the conviction of everyone who understands what this metal actually represents. But underneath that falling price, the physical reality is tightening. Industrial demand is accelerating. The monetary environment is evolving in ways that have historically been constructive for silver. The gold-silver ratio is signaling deep undervaluation, and the divergence between Eastern physical markets and Western paper prices is building a tension that markets do not sustain indefinitely. History does not repeat, but it does rhyme. And every time we have seen this combination of factors, supply deficit, paper physical divergence, extreme ratio, monetary uncertainty, smart money positioning quietly against the retail narrative, the eventual move in silver has been significant. The question is never whether silver will reflect its fundamental reality. The question is always whether you will still be holding it when it does. Think carefully, do your own research, manage your risk appropriately, and pay close attention to what happens next. Because if the conditions we have discussed today continue to develop, the biggest move in silver may not be behind us. It may be just ahead.